Well, good morning, everybody. Thanks for attending. Delighted to talk about the gold royalty story, but what I thought I'd do is talk about some of the common questions I'm getting from investors as we tell our story on the street. And question number one is, why hasn't the gold price responded to the inflation cycle that we're currently experiencing? And in fact, the reality is it is responding extremely well. If you look at the gold price in virtually every major currency in the world, it's at all-time highs. And in spite of the fact that we've seen a flight of capital out of major currencies into the US dollar, gold has performed like a champ, not only in the face of that flight of capital, but also rising nominal rates, record rises in nominal rates over the last couple of years. Gold has actually achieved all-time highs against the US dollar as well. And the reason that's happening is because interest rates are not actually going up. They're certainly going up in nominal terms, but on a real basis, they continue to dive deeper and deeper into negative territory as inflation continues to accelerate. And we believe the Fed has pivoted prematurely, and it has to do so because debt levels on an absolute and relative basis are at all-time highs. Debt to GDP globally is at 350%, and that's debt at every level, whether it's governments, corporations, individuals. But also, when you compare it to where it was in the last big inflation cycle 50 years ago in the 1970s, at the time, the debt levels were only 100% of GDP. So 3.5 times the debt levels on a per capita basis, which means that the Federal Reserves and central banks globally have very limited latitude to raise their interest rates on a real basis without bankrupting governments, corporations, and individuals. That's why we believe gold is going to continue to accelerate, because the Fed is pivoting. Even as inflation, it becomes more deeply entrenched, continues to accelerate. That means interest rates on a real basis will dive deeper into negative territory. The other common question I get is, why haven't gold equities performed? And that's true. Gold equities certainly have not reflected the rise in gold prices, and there's a couple of reasons for that. We've seen shrinking reserves. So there hasn't been any significant capital invested in the junior sector for over a decade, and as a result, there's been a paucity of new discoveries, which means reserves have declined globally by 40% across the gold sector. So the industry is shrinking. The value in the ground is continuing to shrink. The other thing is inflation is reared its ugly head within the gold sector as well. And we're seeing a re-acceleration of input costs in the mining sector as mining companies start to report their guidance for 2024. That means that even as the gold price goes up, margins are being pressured within the gold sector. So that's created an overhang in the sector. So that's why, after 34 years of building and operating mines, I've decided to run a royalty company, because what royalty companies provide, that model is exposure to the gold price while protecting you from inflation. It's top-line exposure, and it provides you also diversification. There's no limit to the diversification that we can achieve within a royalty model. We have over 240 royalties in our portfolio, and we could run a company 10 times the size in terms of the number of royalties without actually having to increase our human footprint. So that means margins will continue to expand, and diversification is limitless in a sector where diversification is difficult to achieve, particularly in the face of declining reserves across the sector. The other thing that we offer, and the previous speaker talked about the power of discovery in terms of creating value, is exposure to the exploration success of our underlying operators. We have over 80 operators within our portfolio of over 240 royalties. And last year, they invested over $200 million in exploration on their 240 properties. And we had broad exposure to that exploration upside without actually having to pay for it. Again, that's the attractive thing about the royalty model. We have over 240 royalties. They're bought and paid for. We never have to put another dime into them. We don't have capital calls. We don't contribute to the exploration in these underlying projects, but we get full upside to the exploration success of our underlying operators. So again, absolute leverage to the gold price while protecting you from inflation, but also significant exploration leverage through the exploration efforts of our operating partners who own over 240 properties within our underlying royalty portfolio. The reason we've been able to grow our portfolio out so quickly and so dramatically is because we have a deep management team. Many of the people within my board of management have similar experience levels to me, with over 30 years in the industry. And not just as financial engineers, many of us have been operators and developers. And that gives us two significant advantages. One is it gives us a clear-eyed view of the underlying risk of what we're investing in, so we can price it appropriately when we put capital to work. But also, it gives us significant access to virtually anybody in the sector. There isn't anybody in the industry that we can't pick up the phone and talk to look at new exploration and new royalty opportunities. That's why we've been able to grow our royalty portfolio in 3 short years from 18 royalties in our IPO to over 240 royalties today, and have significant growth inherent in that portfolio in terms of our revenue. If you look at what we've done since our IPO, and we only IPO'd in March of 2021, so we're just approaching our 3rd anniversary, we've seen our royalty portfolio increase nearly 14-fold. And on a consensus basis, and we have 7 analysts that cover us in the sector, we've seen our net asset value on an absolute basis grow 5-fold on a consensus basis, but only seen our share count grow 3.5-fold. And all those shares have been issued in the context of an M&A, where we rolled up 3 of our competitors over the course of 2021 to deliver that significant growth in our royalty portfolio. So what the arithmetic tells you is that we've grown net asset value on a per share basis by 40% over the last 3 years. And while the market has been soft for gold equities, that kind of fundamental value creation will start to get recognized as we see a rotation of generalists back into the sector, as gold starts to capture a bid, as we see a re-acceleration of the gold price, which we think is inevitable as interest rates start to go down deeper and deeper into negative territory. And again, we provide optimum leverage to exploration, optimum leverage to the gold price, while protecting you from the inflation that we're likely to see in input costs, capital operating costs among the operators and developers in the sector. We deliver peer-leading growth, 60% compounded annual growth in our revenue right through the end of the decade, again, from a very diversified portfolio of royalties across the Americas, growing from just under $6 million in revenue in 2023, doubling this year and seeing our revenue grow to $50 to $60 million by the end of the decade. And we're pivoting for the first time into free cash flow positive territory this year, which is remarkable for any startup company. Again, we only started with a concept 3 years ago, IPO'd in March of 2021, and have already pivoted to free cash flow positive territory in less than 3 years since our IPO. From a very broad portfolio of royalties across the broad spectrum of the value creation equation within the mining sector, from early stage exploration right through to cash flowing assets. We have 5 of them in the portfolio currently, 14 in construction and development, delivering again that 60% compounded annual growth and revenue right through the end of the decade, and significant positive free cash flow creation starting this year from a very small administrative G&A footprint, only $6 million of cash G&A. And again, we can run a business exponentially larger with the same human footprint that we currently have, and not have to significantly increase our G&A expenses, which means every dollar of revenue growth over the course of the next 5 or 6 years falls right to the bottom line, increases our potential to return capital to shareholders. And not to leave you with the impression that this is just a matter of throwing long-dated optionality against the wall to see what sticks. We have some of the most significant producing assets within the Americas. We have royalties on 3 of the 5 biggest producing gold mines in North America. So it's not just a quantity proposition, it's a quality one. We have a royalty on Canadian Malartic, which is Canada's biggest producing gold mine. We have a royalty on Côté, which comes into production this quarter. IAMGOLD's operation in Ontario, which will be Canada's 2nd biggest producing gold mine. And we have a royalty on the underground extension of Goldstrike, the biggest producing gold mine in the US, operated by Newmont and Barrick. So again, it's quantity and quality. We have significant optionality, but we also have generational assets that provide a foundational element for our shareholders for many decades. So these quality assets really will be delivering revenues and annuity for our shareholders for many, many years to come. So again, to kind of wrap things up, what the royalty model provides you is top-line exposure, optimum leverage to the gold price while protecting you from inflation. Virtually all of our royalties are top-line royalties, NSR royalties, which protect you from input and capital cost inflation. Our 245 plus royalties are completely bought and paid for. We have no capital calls. We have no commitments, no exploration commitments. We're exposed to over $200 million per annum of exploration by underlying operators. Last year, that translated into over 600,000 meters of diamond drilling. So that discovery potential is there within this portfolio, within this story, without actually having to pay for it. And we have peer-leading revenue growth, 60% compounded annual growth in revenue right through the end of the decade from a broad portfolio of over 240 royalties within the Americas, with 80% of that royalty portfolio by number and value within Nevada, Quebec, and Ontario, three of the best jurisdictions in the world in which to operate and discover new deposits. Thank you very much for your time.